Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff published his note on Sunday evening, which is available to subscribers on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content. Jeff, welcome back.
Great to be here, Mehdi.
So as we film, futures are a little bit weaker, down about 20 basis points, and a familiar narrative. What's happening with the debt ceiling? Will they resolve it? Won't they resolve it? June the 1st, dates are being thrown around, all sorts of things. There was some weakness in the European markets, which was led by luxury profit taking. There's some chatter around that concerns may be rising that I feel could be a canary in the coal mine for mega cap techs in the US. Jeff and I have talked about this over the last several weeks as well. But enough from me. Jeff, why don't you kick us off with your top down?
Sure. Last week we saw the S&P 500 rally about 1.7%. We busted out to a new recovery high, which was not unexpected. We had been talking about a pattern that we identified a couple of weeks ago as an island reversal pattern that had a pretty high probability, at least a 55% probability that the market would carry to a new recovery high. In fact, it did. It broke our prior Elliot Wave count, which was really not a big deal because we've actually been running a parallel count on the S&P 500 equal weight index. And that count had been running at one larger degree of trend, primary degree of trend. And all this really did is bring the cap weight index into synchronicity with the equal weight index in terms of our count. And so the alternate count was upgraded to preferred status. That suggests now that we're in the midst of primary wave 2 up. And that is tracing out what is known to Ellioticians and market technicians as a double zigzag pattern, two ABCs connected by an X wave. And all that really suggests is that, the market can push a little bit higher. We've talked about a level of 43.12, which is a 61.8% retracement level. That's an area that we're looking for is a fairly high probability peak for this advance. One of the things that really keeps us in the bear camp as opposed to, shifting to a bullish bias is we really can't come up with a high probability bullish count in any of the major averages, least of all the Nasdaq 100, which has been the best performer. And in fact, if we take a look at the Nasdaq 100 and the Nasdaq broadly, what we see is, myriad non-confirmations between, other markets. So big intra-market non-confirmations. We looked at all of the major broad averages like the Wilshire and the Russell 3000, the Value Line Arithmetic Index. We can look at the S&P equal weight. We can look at the Russell 2000. All of these larger, constituent indexes are failing to make new recovery highs as the Nasdaq and the cap weight S&P make new highs. The Dow hasn't made a new high. The Dow comp, which includes transports and utilities as well, has not made a new recovery high. And so, these intermarket non-confirmations suggest that, this is probably not a new bull market advance. In fact, it is the weakest advance for the NASDAQ 100 off of a bear market low, if in fact the October low was a bear market low. Of all, I'm sorry, it's the second weakest of the 15 other rallies that we've seen off of this sort of a decline. In fact, if we look at the S&P 500, it even goes back further. It's the second weakest compared only to the 1957 recovery rally. And so, that tells us, when we're about 150 days into the recovery and you just can't get anything more than the second weakest in the last, 60 years, well, probably not a new bull market. So, we continue to be in the bear camp. We think we're very near a primary wave 2 high, probably in the days ahead, somewhere between where we are and 4,300 on the S&P. And from that level, we expect the market to reverse hard down to new lows that should carry prices significantly below the October 13th low. Having said that, we continue to advise our clients and all investors watching this to be patient. You're not going to miss it, okay? Be patient, minimize net equity exposure, and maximize cash reserves. You can get paid 5.25% to avoid risk right now. That's a gift, and we would advise investors to take it.
So, Jeff, you ran through a couple of salient points there that you've actually been consistent with over the last several weeks as well. It's quite interesting, and obviously, the major media outlets are watching our show as well because they've started that narrative that you've been consistent with on, equal weighted S&P versus the market cap weighted S&P and that divergence in the performance. So, you're on it, and that's obviously something that the media outlets are now starting to catch up on. So good for you being ahead of the curve on that.
Yeah, thank you.
So this week, you kick off your weekly piece with an interesting chart. I want to reference this one first. It's long-term rates. Are they starting to reverse?
It looks like it to us. We can't be certain at this point, but we have seen the 10-year Treasury yield take out a relatively important level of resistance, and it's basically put in a multi-month base that has resolved to the upside at this point. We haven't broken the downtrend yet, but once that is confirmed, then I think there's a pretty good shot that rates are going to rally back toward the cycle highs of around 4% on the 10-year. We've seen 5 separate occasions dating back to December of 2021, where basically we've seen Treasury yields peak, roll over, then rally again. And as they've rallied, the S&P 500 has peaked, in the same neighborhood and rolled over and bottomed around the time rates peak for the next cycle reversal. And so the real question we're asking at this point, is this going to be the 6th episode that we can observe? And we've illustrated this in a chart, and it appears that certainly just given the recent recovery high in the Nasdaq and the S&P, we probably have some work to do on the downside to catch up. But I think if rates do bust out above the downtrend, we'll start to see some weakness show in the major averages. And I would expect, if we do carry the new recovery highs in the 10-year Treasury yield, the S&P will be plumbing its lows by then.
If we've seen a loose inverse relationship between the US dollar and the S&P, are we now looking at the dollar moving higher again here?
If rates carry higher, I think the dollar will follow. The dollar and 10-year Treasury yields are pretty highly correlated. And so, similar to that loose inverse correlation that exists between Treasury yields and the S&P, you've got a similar relationship in the US dollar. What's slightly different here is that, on 4 separate occasions, as the dollar's gone up, the S&P's gone down. But since October, we saw 2 instances where the dollar has broken down and the S&P has rallied. The dollar then subsequently got a counter trend reversal, and the S&P pulled back. But then the dollar broke down again and the S&P rallied. So the question that we have to ask right now, with the dollar showing some evidence of breaking out as well, that's following that 10-year Treasury yield, and if we do see some follow through with the dollar to the upside, our suspicion is that the S&P will roll over in kind, and we'll see that inverse relationship, come back to fruition. It does tend to move with a bit of a lag relative to the dollar. They're not perfectly in sync, the 10-year and the dollar, but they're very closely correlated.
So flipping to another index, which you referenced in your opening statements, the Nasdaq, it's had a decent run this year. Are you seeing cracks emerging in this?
We are. Last week, we published an interim bulletin. That's a midweek publication where we highlighted some intermarket non-confirmations between the Nasdaq 100 and the broad indices that I mentioned at the outset of this conversation. And we think that there are some internal weaknesses that have emerged as well that we highlighted this weekend in the weekly playbook. Specifically, we decided to look at the broad NASDAQ composite and compare that to the cumulative advanced decline line for the NASDAQ. And what we're seeing is that as the NASDAQ composite has made new highs, the advanced decline line has failed to confirm it. There is a significant negative divergence between the NASDAQ composite and its cumulative advanced decline line. That is, in and of itself, reason to be concerned. But when we overlay on top of that, net new highs in the NASDAQ composite, we see a similar negative divergence. These negative divergences tend to precede a trend reversal. And we saw a similar situation at a higher degree of magnitude emerge in the months immediately preceding the peak in the NASDAQ composite back in November of 2021. It took about 6 to 8 months for it to materialize at that time. It now looks like it's more like 3 months. And so, we're at a lower degree of trend. The peak in the NASDAQ was a super cycle degree peak. We're at primary degree peak. So we wouldn't expect these divergences to be as extreme at this level. My suspicion is, though, they are signaling a major trend reversal in the hours to days immediately ahead.
We know your bigger picture view. We've been through this over several months, and you've been very consistent in what you've been sharing with us. You touched on this as well in your opening remarks, but can you run us through your short-term Elliot Wave views?
Yeah, like I said, price action last Thursday did carry the major averages, the NASDAQ 100, the NASDAQ composite, the S&P 500 to new recovery highs. They were unconfirmed by the broad market indexes, but it did happen to break our prior preferred count on the S&P 500. Our preferred Elliott count at that point was that we had thought primary wave one bottomed in June of last year, and that the October decline was actually, or the October low actually marked intermediate wave one down of primary wave three down. That obviously is not the case since we took out that recovery high. We've still got work to do here. So what we did is we basically moved the entire count back to primary degree. That suggests that the October 13th low last year was the end of primary wave one down, and that primary wave one actually traced out what's known as a leading diagonal triangle. Now, leading diagonal triangles can come in two forms. They can either be converging or expanding. And in this case, we saw an expanding diagonal. And that's a rare pattern. And it only occurs at the beginning of a bear market trend. It only occurs in a downtrend. And it is a leading factor. And so we actually had the exact same pattern modeled when we look at the equal weight S&P 500. So what we did is we basically brought the two counts into synchronicity. So from the October low, we are seeing basically what's known as a double zigzag corrective waveform tracing out. It's an ABC that ends at W. It's bifurcated by an X wave, and then we have another ABC. And so the count is WXY as a result. And so wave C of Y is in its terminal stages right now. We expect, honestly, it's quite possible that the gap resistance that we've illustrated in this chart could contain the wave C of Y and could hold primary wave two to something in that kind of 41.95 to 42.28 gap range. That's a possibility. A slightly higher probability terminal point for this, primary wave two recovery rally would be S&P 4312. That's the 61.8% retracement, the golden ratio. And Elliott waves tend to be, they tend to conform to Fibonacci sequences. And so, we tend to see, them broken down into sections that are 61.8% to 32.8%. So, or 38.2% rather. And so we get these sort of sections that have, traced out. And so it's a high probability, since we've exceeded the 38.2% level, that the 61.8% level is likely to come into play. So that's kind of our targeted level, but it doesn't really even matter. Regardless of where primary wave 2 terminates, the next thing to think about is primary wave 3. Primary wave 3 down will be a spectacular plunge to new lows. The third waves tend to be the most dynamic, most powerful, and and has the most implications for markets. And so, I think the implication here will be that we have confirmed that the bear market is still alive and well once this primary wave 3 down ensues. And I think it's going to shake investors to their core. There is a lot of CTA money that has gotten long. A lot of quantitative funds have taken advantage of this compressed volatility that we've seen to get to the long side. And our view at this point is basically that all of that money is very fast money. It can reverse just as quickly as it got long. It will get short. Okay, and so you got about 1 million or so contracts on the long side at CTAs. It's the heaviest, weighting that we've seen in terms of the COT data, commitment of traders data, in a long time, since pre-COVID. And so, this open interest is very high. You've got CTAs dominating the long side. It's fast money. They're not fundamental investors. They will reverse that position as quickly as they got it. And that's what we think will carry this third wave very rapidly below the October lows. So, that's kind of where we're at right now. The other thing that I would point out is that there are some time cycles in play here. They began October 19th. Another key date would be May 22nd through May 24th, which is the 50-day cycle. And then they end on June 3rd, another minor Montgomery cycle turn date. So anywhere in there is a good point for the market to peak in primary wave 2. The final thing that I'd point out about time cycles is, they oftentimes invert. Okay, and what that means is that you may be looking for a low based on how the cycle is traded in the previous sort of periodicity, but it backfires and you get a high instead. And so that happens more often than a lot of cycle analysts even realize. And so we think it's a high probability that in this window we're going to see a peak, when a lot of people, including ourselves, were looking for the 50-day cycle to bottom. And so the 58-day cycle might actually peak. And so we'll keep our eyes open here over the next couple of days. The 24th is the final day of that 50-day cycle. And if we see the peak tomorrow, then it would be right on schedule. But regardless, we expect a peak in the days ahead, if not hours ahead. And what will follow will be an epic plunge to new lows in the S&P 500. Our target price for primary wave 3 down is a minimum of 2,700 on the S&P 500. I think that's a level to keep in mind, because if we think about valuations right now, you can make a pretty good valuation case for 2,750 to be fair value. So it wouldn't surprise me to see the market just simply trade to fair value. And then, we got this debt ceiling that you pointed out at the outset. And a lot of times markets peak on good news. Maybe we get a resolution to the debt ceiling, and that is what actually causes the market to peak. Because what comes after the debt ceiling resolution? More debt. And that, we're hearing something on order of $1 trillion of treasury bill issuance will follow immediately, upon a debt ceiling resolution.
Thank you for breaking all that down, Jeff. And this week you've also, we discussed this at the outset. The fact that US technology has been quite the driver in these markets, and specifically seven names that you're going to go into as well. Let's have a look at some of the sectors, and obviously technology has been, as I just said, quite the outperformer. But talk us through some of your thoughts around this.
Yeah, if we look at last week's performance, just as an example, the S&P, as I said, was up 1.7%. But if we take a look at the FANG MT, so we're talking about Facebook, Meta, Apple, Amazon, Google, NVIDIA, Microsoft, and Tesla. Okay, those are the key names, the seven mega cap tech names that have really been driving this market all along. They were up 3 times the S&P 500's performance in aggregate. Okay, if we look at the S&P equal weight, okay, that was up less than 1%. The FANG MT was up 6 times the average stock in the S&P 500 just last week. Okay, that is endemic of a blow off top. That is very atypical behavior, even from leadership, to outperform the average stock by 6-fold or greater. So what we saw last week were these breakouts across, the three key sectors: communications, technology, and discretionary. Well, communications has two big stocks in it, Meta and Google. Those two stocks account for 50% of the market cap of the XLC. The XLK, the technology sector, has three big stocks: Apple, which is now 7.4% of the S&P 500, an all-time record high for a single stock as being represented in the S&P 500, Microsoft, and NVIDIA. In aggregate, those three stocks account for 50% of the tech sector. Okay, and then we got discretionary, Amazon and Tesla, and those two stocks account for 40% of the discretionary sector. Throw in Home Depot and it's 50%, although Home Depot has not been a big performer. But the point is those sectors are dominated by the FANG MT stocks. And those FANG MT stocks are looking tired. In fact, I heard an interview with the woman who runs the QQQ Trust. Okay, this was maybe Friday, I think. Maybe it was Thursday. And that interview indicated that flows into the QQQ Trust have been flat year to date. And so what it tells you is it's not individual investors or even fundamental long investors that are putting new money to work in these stocks. What it is it's CTAs that are buying the futures contracts. Okay, and that's what's bidding it up. And options traders who are shorting the 0 days to expiration call options on these or put options on these names or the ETFs themselves, and that's what's driving it higher. And so the point is that you've got these weak breakouts, and anybody who's been looking at breakouts knows that we're not seeing a lot of follow through this year. I mean, there's only, I think, 29 stocks in the S&P 500 that are outperforming the index year to date. Okay, 29 out of 500. So you're not getting a lot of breakouts that are following through. Even though these three key sectors have broken out, there's some overhead resistance that's, on a nearby basis, likely to contain these moves. And so my suspicion is that these breakouts will fail. And, we have been kind of discussing this with our clients, saying, look, if you have to own, long positions, these stocks are working and you want to own them until they stop working. So you want to keep a tight stop. And so we're suggesting that, if this thing does carry higher in the days ahead, stick with them until they break. We don't want to short into strength. We want to short into weakness. And so, we have not been suggesting to short these stocks. We've been saying either avoid them and sit in T-bills or ride them and be prepared to sell them when they break their support levels. And, that level is different for every investor because every investor invests with a different time horizon.
Totally understood. Thank you for that breakdown. I really appreciate you sharing your thoughts on these ETFs as well, because I know we have a lot of viewers asking questions around specific ETFs. So that's very helpful. Jeff, how do we make some money in this? You always have your top actionable trade ideas. So, what are we going to do this week?
Well, if we're not advocating being aggressive in these, tech and discretionary areas, where are we advocating? We've been saying stay defensive, right? And one of the areas that has been very high on our radar screen has been healthcare. And in particular, we've highlighted a name this week called Tenet Healthcare. It's a hospital company. Stock went out around $72, $73 last night. That stock broke out nicely above $67. It was about a year-long classic pattern base formation of the head and shoulders variety. The breakout above 67 gives us the ability to count a measured move to $97. If the stock carries to that level, it would be around a 33% upside return. So we like that upside potential. We'd set our stop loss at 66, just below the breakout level. That sets up a nice 3-to-1 positive risk skew for the trade. On the short side, there's a company called Topgolf, Callaway brand symbol MODG. Stock went out around 16.5 last night. It broke down below key support at 17 recently after putting in what we as technicians would identify as an inverted cup and handle top formation. After breaking trend, almost 2 years ago, this top formation has taken a long time to develop, and the breakdown below 17 suggests, especially given the very weak relative strength and very weak momentum, that the stock is ready to give way. The pattern itself targets a level of $7 to the downside. That would be a 57% gain for a short seller at current levels. We would set our stop loss at 18.5. That sets up a very attractive 5-to-1 positive risk skew relative to our target price. If you're a long investor, we would just avoid this stock altogether.
Great. Jeff, as always, thank you so much for sharing your thoughts from Alpha Insights. And I feel like we got an added bonus this week with some Fibonacci and Elliot Wave theory conversation and teaching during the technical chat. So thanks for that.
That's my pleasure.
And I want to thank our viewers and urge you to check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, good luck investing.